Yeah,
In
that's a good
investing,
question. It's
timing and
actually a
strategy
timing
shape the
question
deep value
to
investor's
some degree.
journey.
Well, there's two elements to it as a deep value investor. One element is dividend income stocks. So I will buy dividend paying stocks, high dividend paying stocks that are deep value, and I don't need them to go up.
Right.
Okay.
These are dipping
When I
into.
do that, I don't necessarily look at cyclicality of the sector that the companies happen to be in. Could be a spark plug manufacturer, it could be a daycare center in Hong Kong. Those are the kind of things that will fill our dividend portfolio. Okay. We're not looking for catalysts. We're looking for deep value, no debt, low debt, cash flow, just spitting out, churning out cash companies. And they take a bunch of that cash and they send it back to shareholders 10, 12, 15% sort of dividends, sometimes a little bit less. The results are basically to some degree, and we've run that for about 5 years now, and that has kept up with
Crutch.
the S&P 500 with
Mhm.
much dampened volatility. So, and this is in an environment where dividend paying stocks and allocation towards dividend paying stocks by asset managers is at a 14-year low.
Mm.
Okay, so if you can do what we've done and still do as well as the bloody S&P with much less volatility, if we do have a an actual total rotation where investors go, oh, I'm not going to chase growth stocks. I'm going to go after stable shit that's not going to go away, that's going to pay me. Fine, we can have some fairly aggressive revaluation, but we're not buying it for that. It's not a speculation on that. We're buying it because we can compound dividends at 8, 9, 10%. That's a
Mhm.
phenomenal return if you can do that consistently, which we've done. So that's the one thing. The other side with respect to sector or country allocations like Argentina, in many instances, and you'll see this in our work, we are looking for these ECG charts on a dead guy, right?
Mm.
Like where the stock chart is just flat. And it's been like
Flat.
that for 10, 15 years. But Jim Rogers famously says that, bottoms in stock markets don't come in 4 or 5 year cycles, they come in 10, 15-year cycles.
Mm.
And that's broadly speaking is accurate. So we will often be looking at that and saying, okay, cyclically, if it's something that we're buying, which is a cyclical asset class, which commodities is, Argentina is not necessarily, but just pointing this out, then we will look to what that looks like. We'll go, for example, if you've got commodities, which is, can be 10, 15-year cycles, and
Mhm.
we're at year 14 or 15 and it still hasn't moved, like we go, we'll buy it because we're patient and we can sit and provided the valuations are very attractive, then like we're not looking for a catalyst. We just know cyclically that there'll be a reversion to the mean.